So that's a bit of a worrying point. Communication, which has been weak for rest of the peers as well, seems to be weakening for Infosys as well. However, retail, energy and manufacturing, that is what is holding out okay. And healthcare and life sciences as well has been doing well for TCS. Ditto can be said for Infosys as well. Omkar Tanskale is joining us on the phone line to discuss these numbers. Omkar, your first take, what explains the guidance cut on one hand and a solid beat in Q2?
Yeah, I mean, definitely, there is a quite a worry of, delaying the decision making, and the positive news from the North American side is not coming in a way that shows, I mean, it's not been a quicker recovery for the Indian IT services as well. For as of now, as they are going softer on a hiring side, which clearly indicates the ramp up. There are delays on a new ramp up of the deals that they have won in the previous quarters, whether it is being liking of getting the robust deal pipeline even in the challenging times. But still, there will be a delay in the recovery for next couple of quarters at least that one can make out for the lowering down the guidance range by around 1.5%.
Taken, but you know what, Omkar? FY24 being a washout year for sorts is something which is penciled in. Even the guidance of 1 to 2.5% pretty much factors that in. The question now is FY25, and will there be a double-digit growth there? The order inflow number of around $7.7 billion, doesn't that give you the confidence that maybe it's a slow year FY24? Yes, but if you're a long-term investor, FY25 might still be very strong.
Yes, I mean, definitely one can look upon, the demand for the new generative services like the generative AI and still coming, whether it is for Accenture, whether it is for TCS or for Infosys, all of the services that, indicating that there might be a recovery. But we are not aware of, how much it will take to, getting the project delays and delays in the decision making, because, we can just estimate that there will be a recovery, but I believe the visibility is still not there because they are going so soft on the hiring side that reach level is decreasing. The majority of the effect of, I believe on the margins are coming with reduced employee cost, and which is likely to impact. So it might be, also a time of a worry that one can look upon how much time it will take, that one should be looking off, and how it is being getting ramp up. But if there is a recovery, there will be a better in terms of getting the revenue growth momentum back on the track.
Momentum back, but which are the key questions, Mahantesh, that you would want answered in the press conference, which is lined up at 4:30?
They have grown 3.3% for the 6-month period on a YOY basis in constant currency terms. And with the guidance at the top end being 2.5% for the whole year, it tells me that they're expecting the second half to actually be a degrowth kind of half year. I think they need to explain why is that, given the background that they have such large deal wins already happened. I think that's something which is a bit surprising or unexplained in a way. Why are they not upping the guidance when the deal wins are so strong? Obviously, it could mean that it is FY25 in terms of overall ramp up, but surely you can't have a degrowth kind of second half of the year ahead.
No, I think, of course, there would be a bit of seasonality that they have factored in, but you're absolutely right. From a 3% plus kind of growth, why are they sticking with 1% possibility as well? Lastly, before I let you go, Omkar, a word in terms of the pecking order for the stocks right now, and what's your expectation of performance of large cap versus mid caps?
Yeah. My pecking order for the quarter, I mean for the large caps, is still HCLTech being top in the orders, then TCS, and then the Infosys, and then Tech M and Wipro. But I still believe the mid cap is likely to outperform the large caps. In that case, Persistent and Coforge will be a top picks among the mid caps.
Point taken. Thank you, Mahantesh, as well as Omkar for joining us. So that is the first analysis as far as Infosys numbers are concerned. If you look at the Q2 performance, it looks like a beat on all parameters because the constant currency growth came in at 2.3% versus our expectation of 1%. The margins came in at almost 21.4 versus the 21.2, I beg your pardon, versus expectation of 21, and the profitability too looked better than our expectation. Not to forget the fact that the deal wins were solid at $7.7 billion. Then why that 4.6% cut that you are seeing in Infosys area, which is trading in the US market right now? Well, the reason is that there is a sharp cut in guidance. The guidance now stands at 1 to 2.5% versus 1 to 3.5% that was earlier. A bigger disappointment because Street was expecting that the lower end of the guidance will be raised upwards. That hasn't happened. Secondly, if you look at the internals, the headcount has actually dropped by 7,530. Another bad news spelling in. That tells you that perhaps the management does not have too much confidence in terms of the near-term visibility, and hence they are staying away from adding more costs and perhaps don't want to have a bench strength when the order inflow and execution isn't really picking up. So that's the latest that we have for us. The guests on the show were talking about how there seems to be a bit of a dichotomy and the fact that there might be some cuts that might come in place for Infosys, given the fact they're expecting the second half of the year to be slower than the first half. But with that, we'll slip into a very short break. Don't go anywhere.